Hello, I'm Jeff Panic with Balanced Wealth Partners. And if you've been hearing about the one big beautiful bill that was just signed into law, you're probably wondering, what does this actually mean for me and my investments? Well, I've spent some time reviewing this 870-page piece of legislation, and today I want to break down the key changes that will directly impact you as an individual investor. This is the most significant tax reform we've seen in years. So let's cut through the complexity and focus on what really matters for your financial future. First, let's understand what the bill actually does. The One Big Beautiful Bill Act makes permanent many of the tax cuts from 2017 that were set to expire at the end of this year. Think of it as extending and expanding tax benefits that were scheduled to disappear. The bill affects three main areas for individual investors: your income tax rates and deductions, how your investment gains are taxed, new saving opportunities for families. But here's what's important. While capital gains tax rates stay the same, that's 0, 15, or 20, depending on your income, many other changes will affect how much you keep in your pocket. Let me walk you through the changes that will hit your tax return starting this year. Number one, income tax rates. The current tax brackets 10 to 37 are now permanent. No more worrying about rates jumping up in 2026. Number two, the standard deduction. This gets even better. For 2025, single filers get $15,750 and married couples get $31,500. Plus, there's an additional boost through 2028. Number three, state and local tax deductions. Here's a big one. The SALT deduction cap jumps from 10,000 to 40,000 through 2029. If you live in a high tax state, this could save you thousands. However, be aware, it is subject to a phase out for taxpayers with incomes above 500,000, reducing the cap to a flat 10,000 thereafter. For seniors, if you're 65 or older, you could get a new 6,000 per person deduction that will help reduce taxes on your Social Security benefits. About 88% of Social Security recipients will now pay no federal income tax on their benefits. But be aware, this new deduction is phased out when your modified adjusted gross income exceeds 75,000 as an individual or 150,000 for a couple filing a joint return. For business owners, the Section 199A deduction for pass-through businesses increases from 20 to 23% starting in 2026. If you own rental properties or have a side business, this matters. So now, what does this mean for your investment strategy? Number one, capital gains. The rate didn't change, but the higher standard deductions and potentially more take-home pay, you might have more to invest. Remember, long-term capital gains are still taxed at 0, 15, or 20, normally much better than ordinary income rates. Number two, estate planning. The estate tax exemption is now permanently set at 15 million per person, which is also indexed for inflation. This removes uncertainty for high net worth families. Number three, a new opportunity, the Trump accounts. If you have young children or grandchildren, there's a new savings vehicle called the Trump account. Kids born between 2025 and 2028 get $1,000 from the government, and you can contribute up to $5,000 annually. Think of it as a 401k for kids. Number four, business investments. 100% bonus depreciation is back permanently. If you're considering investments in business or equipment, the tax benefits are now more predictable. So, what should you do right now? First, review your withholdings. With higher standard deductions and other changes, you might be over withholding. Second, if you've been holding off on Roth conversions because of uncertainty, we now have more clarity to plan multi year strategies. Third, consider tax loss harvesting in your taxable accounts. Even though rates stayed the same, having losses to offset gains becomes more valuable as your income potentially increases. Fourth, if you're a business owner, review your entity structure. The enhanced pass-through deduction might change what's optimal for you. Look, tax law changes can be overwhelming, but they also create opportunities. The key is having a plan that adapts to these new rules while staying focused on your long-term goals. If you'd like to discuss how these changes specifically impact your situation, I'd encourage you to schedule a planning review. We can run scenarios based on these unique circumstances and make sure you're positioned to take advantage of these new opportunities. Thanks for watching. Also, please look out for my upcoming book coming out later this year. Your Future is Now, your blueprint for solving your retirement puzzle. In the meantime, feel free to reach out to start a conversation about these new changes and how they affect your planning moving forward.